The big macro news that we are tracking this evening is the inflation in the United States, which has gone up. It's risen more than expected and come in at 3.5% year on year. The core CPI, which is the one that excludes the volatile food and energy prices, that has risen even faster at 0.8%. This compared to March 2023 again. So this kind of data comes in lower than what economists, what experts were penciling in, what they were expecting, and this makes investors rather wary of rate cuts in the future. Remember, the Fed had indicated the possibility of rate cuts this year. This inflation data, of course, remember, is still above the Federal Reserve's target, which is 2%. So what next is the big question? Let's find out. Manish Singh, market expert, joining us, along with Mahantesh Sabarad, to give us both the global and the domestic picture. Manish Singh, to you first, and thanks for joining us this evening. Does this mean that the uncertainty over the Fed's rate cuts is a little less than before? Now we can certainly expect the pivot to be pushed back substantially if you were to look at it that way.
If you look at the headline number, yes. While it's definitely a matter of discussion a lot, but if you let me quote you something. If you see the US CPI increase, the price level increased 2 years prior to the rate cycle tightening, that price had increased by around 11.4%. Since tightening, if you look at where things are, that increase is 8.6%. So the inflation definitely is coming down, and we have seen that in various other measures as well. This debate about when the Fed is going to cut is just not going to go away. And should Fed be cutting rates immediately? Probably no, given the narrative that they have built up, and the number certainly tells you is that the inflation is not the target that they have set, i.e., for it to go to 2%. Purely based on today's number, the market will definitely push back. However, one has to bear in mind that they have two mandates. So inflation is one, and the employment or the economic outlook is the other one. So far, we have not seen a big change in unemployment, so Fed can sit tight. But should that start changing, and if you look at the job report, the most of the job increases are happening in the temporary job sector, not in the permanent. In permanent sector, there has been job losses. I'm sure Fed will be bearing that in mind and not just looking at what the CPI is telling it.
Strong jobs data, now rising inflation, all of these factors are something that the Fed is going to be scratching their heads about. Mahantesh Sabarad, when we look at the run in our own markets, the market cap hitting 400 lakh crore rupees on the BSE, micros, macros looking strong right now, even as there is this uncertainty over the elections, etc. But this risk that the Indian markets, as far as the Fed's rate cuts are concerned, have they been factored in completely? A higher than expected US inflation this time, how is that going to impact our own course?
The higher than expected US CPI print, which is at 3.5%, is, mind you, not very far away from the forecast of 3.4. So there shouldn't be much of an overreaction when it comes to the inflation trajectory. What is more important is, where is the inflation likely to be, let's say, 6 months down the line, 9 months down the line, and where are the rate cuts going to come in? Already, the markets are building in a rate cut somewhere in the range of 70 bips, 75 bips thereabouts. With a stronger inflation that has come in, probably it would be a little more a while before those rate cuts come in. As far as markets are concerned, what really happens is that a stronger US economy coupled with cut interest rates ahead could mean that the asset allocations by a lot of global funds would veer towards the US market itself, and then you also have the competing recovery that is happening in the European markets as well. So India per se facing these odds, which is the election odds, the better economic output or better economic outlook of both Europe and US, could mean that the days for Indian markets are going to be a little better days for Indian markets are going to be a little bit numbered. We are at peak valuation as I speak with you, but the only solace that we have is that these peak valuations are being supported by our own economic strength
Right.
and rising corporate earnings ahead. So it remains to be seen how these asset allocations going forward, but the outlook seems a little bit worrying as far as India is concerned.
Yes, but
When
also we're
these
looking at the private sector kind of capex going up, and that is perhaps going to leverage where our markets stand, and that's another perspective. But Manish Singh, I'm looking at what Wall Street is doing right now. It had taken a percentage point cut on the Dow. The Nasdaq also down about 3/4 of a percentage point as we speak. 0.6 of a percentage point cut on the S&P. Do tell us, we are hearing from President Biden as well, and he now, of course, in election mode, he's asking companies to slash prices after registering what he calls record profits by these companies. Is there any possibility, any likelihood of this even happening?
Well, I think, a lot of that is political talk from President Biden, and he's talking to his audience, i.e. his voters. Now, if you see from the growth point of view, the US economy is growing at a decent clip. So the fact that it has not cut rate, or the fact that the rate cut has been delayed, that should in itself not be a reason for people to sell risk asset. And therefore you have seen the market buys dip. You have seen, if you look at this year, I believe there have been only 5 occasions where the S&P has fallen by more than 1% on a day, and the very next day those dips have been bought. So if you have an economy which is growing, there's plenty of liquidity, you don't need a rate cut for that economy to go up. And you will look at the earnings, and the earnings season will begin tomorrow with JP Morgan, other numbers, and we will find out. But there is a lot of good thing happening in the economy for one to focus on rate cut. Now, rate cut will definitely act as a tailwind when it starts. So if you look at where we are set, GDP is going okay, earnings are coming well enough, and the next stage is rate cut, and that hasn't changed. And this will really help the risk asset. Of course, President Biden wouldn't like to have a recession or anything on his watch.
Yes.
To increase his re-election
Yes,
chances.
of course.
But he will indulge in rhetoric, political rhetoric about price fixing and everything else.
That's right. But Mahantesh, in terms of emulation by the RBI of Fed's rate action in the recent past, how does this place India's interest rate cut trajectory as well, at a time that we see two of our biggest import items, that's crude oil and gold, getting dearer by the day, and the rupee is weakening against the US dollar?
So, the RBI's task is also inflation driven, and therefore they are mindful of where the inflation in India is headed. We have some bit of inflation coming in through the oil price rises that we are seeing, but at the same time, the economic activity right now in India is a little bit hot for comfort when it comes to the comfort of inflation. So the dynamics for the RBI is that they have to be mindful of the gap that they have between the US Fed rate versus our own repo rate, and at the same time be mindful of the inflation that we have. They are projecting slightly higher inflation in the quarters ahead, but not so much when it comes to they are seeing inflation actually tapering off into the next year. In the year, but at least for the coming quarters, we would see some bit of uptick. And if oil remains high, we might see that inflation forecast for RBI as going up. So we have seen RBI has stuck with its repo rate for several policy meetings so far, and they're not in a hurry to cut rates as yet. They would rather wait the outcome of the US Fed Reserve in terms of rate cut than do the rate cuts here. Though I don't think will preempt any move by the US Fed as of now.
Fair enough. But like you also indicated, Manish, that we may be on a good wicket. Now, how much better it can get is something that we are monitoring. But the way crude oil prices are behaving right now, how much of a risk is that to the Fed at this point, you think? How much of that is going to be considered in terms of that rate cut?
Well, I think it will, because the Fed will be very mindful of not giving a signal that they are about to cut rates when the oil price is going up or the headline inflation itself is rising. So if you look at the data we got today, a lot of the headline inflation was driven by auto insurance, I believe. So there are several items. Now that doesn't go into core pricing, so it doesn't change the core PCE expectation that the Fed has. But the Fed will be mindful and just think about from Chairman Powell's point of view and FOMC's point of view. They're not tied to whether they have to cut a certain amount or not. What they're going to look at is where the expectations of inflation is going to be in 3-6 months down the line, and then act. Now, one thing that I pointed out in the past as well is when the rates went near zero, the debt profile changed a lot. The liability of businesses, of consumers changed a lot. So if these duration were extended and the refinancing of that starts coming end of this year, beginning of next year, Fed will have to take that into account. So they will then, in that, they will not wait, and you will see big cuts down the line toward the end of the year, because so far the rates have gone up, but that has not hit many businesses and consumers because the debt profile had longer duration. And that is something that Fed has to really worry about. And then you will see cutting rates, even if inflation was at 3 or where it is today, because you will have really a weakness coming down in the economy. And that, I think, will be topic of discussion probably in 6 or 9 months' time. But for now, the Fed can just sit and do nothing.
Do nothing at all for some time until perhaps they get closer to their 2% target, which we don't know exactly how long it's going to take. There is a certain amount of stickiness in the jobs front. And as far as the Indian markets are concerned, we are heading to our own earnings season. Investors are going to weigh in American inflation as they reposition their portfolio to what could unfold this fiscal. Elections, of course, being the other moving piece over here. And indeed, the July budget is here as well. So all of this under consideration. Thank you very much for joining us with your perspective, Manish Singh, and of course, Mahantesh Sabarad, for joining us on here tonight.
If you like this video, then like, share and subscribe to ET Now.